You cannot eliminate emotion. You are not a machine. You are a man built of nerves and blood and memory. If you somehow managed to surgically remove all feeling, you would achieve two things. First, you would lose the very awareness that drives self-preservation. Second, you would cease to be an effective operator. You would become a drone, incapable of the quick, intuitive adjustments that even the most rigorous system occasionally requires. No, the goal is not eradication, the goal is control. The market is not a fair judge, it is an organized structure designed with ruthless efficiency to exploit your humanity. It is designed to profit off your hope and to crush you beneath your fear. The secret to consistency, to longevity in this game, and I speak from decades of experience at the highest and lowest ends of the scale, is not the elimination of feeling, but the absolute cold-blooded surgical removal of that feeling's influence over your trading action. You must build a steel cage, robust and unyielding, around your mechanics. The animal inside the cage can howl all it likes. It can be ecstatic or terrified. But the door to the mechanism must remain locked. That is discipline. That is survival. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. We must first define the true target. What are we truly fighting? We are fighting the subjective impulse. We are fighting the willingness to deviate from the established plan because we feel a certain way in the heat of the moment. I never believed in eliminating the basic human signals of fear or hope. They are useful indicators like pressure gauges in an engine. Fear tells you the risk is present, real, and perhaps larger than anticipated. Hope tells you that a large payout is mathematically possible. But here is where the inexperienced man fails. He allows the gauge reading to seize control of the throttle. The seasoned operator knows the gauge is only a signal. It is not the master. It is not the governor of the engine. Discipline is the consistent refusal to be governed by these signals. It is the learned inability to deviate from the predetermined plan when those feelings surface. A volatile engine demands a steady hand on the mechanics. When the machine is running hard, when the tape is flying, when your margin is pressed, that is the very moment the human animal wants to snatch the controls. The disciplined man tightens his grip and sticks to the schedule. We are not robots. We are expert mechanics operating a deeply volatile engine. Our job is to keep the machine running true, irrespective of the noise, the smoke, or the internal shaking caused by the market's movements. If we mistake our internal state for objective data, we are already ruined. I have seen countless men, brilliant men who understood the value of every commodity and the trajectory of every industry, be utterly broken by the market simply because they could not separate their nerves from their numerical judgment. They allowed the feelings to become facts. A feeling that the stock must go up is not a fact. A feeling of panic when the price drops 3 points is not evidence of a structural failure. It is merely the internal animal reacting to stimuli. The true consistent trader treats his fear and his hope the same way a farmer treats the weather. He acknowledges it, but he does not let it dictate whether he harvests the wheat today or tomorrow. He sticks to the schedule set by the needs of the crop. You must view every trade as a small enterprise you have launched. You have established the initial cost, the necessary investment, and the point at which that enterprise must be liquidated, the stop loss. If the internal animal squeals that liquidating is too painful, you must ignore it. Pain is temporary. Following the system is eternal. The consistent trader knows that the greatest consistency is found in the complete and total submission to method. The method must be the superior intelligence. The trader is merely the executing agent. And what feelings seek most often to seize the control panel? I found that throughout my career, two emotions reigned supreme as the destroyers of capital. They are the twin tyrants of the trading desk: fear and hope. They work in tandem to guarantee failure. Fear is the paralysis that prevents profitable execution. It is the cold clamor in your chest that screams, "Take the money now, it might disappear." This causes the novice speculator to cut his winners short. He grabs a quick profit of 3 points when the market was preparing to give him 15. He takes the money because he fears the paper profit might vanish entirely. This is the failure to pyramid successfully. This is the failure to let a winner run. Fear ensures you never capture the large move. It ensures you always have small, insignificant victories that are quickly swallowed by the unavoidable larger losses. Hope, however, is far more insidious. Hope is the delusional comfort that a loss will come back. The moment a trade goes against the inexperienced man, he stops analyzing the market and starts praying to the ticker tape. He holds a losing position, watching his capital erode because he clings to the hope that the trend will reverse just long enough for him to break even. This is the ultimate violation of discipline. Hope causes the speculator to violate his stop-loss. Hope demands stubbornness, convincing the trader that his original assessment must be correct, despite all evidence to the contrary. Fear causes inaction when action is required, holding losers too long or selling winners too early. Hope causes stubborn, reckless action when preservation is required, doubling down on the loss, refusing to liquidate the position. The only way to neutralize these two tyrants is to pre-commit to a system built purely on objective price movement. You must establish, before the trade is ever entered, the point where the market proves you wrong, and the point where the market provides you sufficient reward to continue holding. When fear surfaces, the systematic trader looks at his predetermined stop or target. If the price is not hit either, fear has no jurisdiction. When hope whispers its sweet, poisonous lies that the market will reverse just for you, the systematic trader looks at his trailing stop or his maximum risk limit. If that limit is breached, hope is instantly executed. You must understand this distinction absolutely. Your system must be based on objective price movement, not subjective internal pressure. A stock dropping below its critical support line is objective price movement. Your chest tightening because you might lose $20,000 is subjective internal pressure. Only one of these matters in the execution. Only one of these should compel action. The emotional man views trading as a sport, a great contest where personal skill and intellectual superiority are tested daily. He wants to win the day. The greatest lesson Livermore ever learned was the cost of emotional trading, a painful market penalty paid over decades of volatile schooling. Fortunately, you can absorb that same wisdom without incurring the expense. In 1923, Edwin Lefebvre published the definitive account, Reminiscences of a Stock Operator, chronicling the journey of the great speculator we know as Larry Livingston. Reading this work is akin to entering a historical training ground, allowing you to experience his critical errors and eventual mastery vicariously, thereby refining your own temperament before capital is committed. To properly bridge the gap between his era and ours, however, you need the interpretive lens of the Max Davidson Annotated edition. It supplies the necessary commentary to ensure Livermore's timeless principles translate directly to the modern financial landscape. A link to this essential edition is provided in the description below. The disciplined man views trading as a business, a tedious, methodical enterprise dedicated entirely to generating positive cash flow over time. He wants to win the quarter. When you treat trading as a sport, you are susceptible to ego, rivalry, and impulse. You bet large when you feel confident. You chase positions when you feel behind. You are gambling. When you treat trading as a business, every single action must have a quantifiable expense, the stop loss, the risk, and a quantifiable potential return, the target. My longevity came not from predicting the future better than my competitors, but from viewing my capital strictly as inventory and my risk strictly as overhead. If I run a hardware store, I do not spend my inventory on foolish whims. I measure the expense against the potential profit for every nail and every hammer. In speculation, capital is your inventory. It is the raw material necessary to conduct business. To waste it on impulse trades or to let it deteriorate in a poorly managed losing position is the quickest way to guarantee corporate bankruptcy. Impulse trades are emotional expenses. They are overhead that serves no logical business function, and they guarantee inconsistency because they introduce random variables into a scientific model. I knew that true discipline was simply adhering to the profit and loss structure of my enterprise. If the business plan says, limit the loss to 100 units, then when the market delivers a loss of 100 units, the business plan dictates liquidation. There is no negotiation. There is no appeal to sentiment. If you cannot view your capital as merely numerical inventory devoid of personal attachment, you will never survive the necessary draws and setbacks. The disciplined man weeps no tears over a necessary calculated loss, because it is simply the cost of doing business. It is the insurance premium paid to keep the enterprise solvent. The emotional man constantly needs action. He needs to feel involved. He needs the rush of the tape and the sense of participation. Consistency, however, is built during periods of intense inactivity. I have said many times that the most money I ever made was while sitting still, entirely in cash, doing nothing. Emotion screams for action. It begs you to get involved lest the train leave the station without you. The system demands validation. The disciplined trader understands that capital is not scarce, but opportunity is scarce. You do not inject capital into the market based on anticipation. You inject it only when the market has validated the setup entirely. The waiting game is the emotional battlefield where most speculators lose the war before they even place an order. Impatience is the most expensive psychological weakness in Wall Street. I would wait for weeks, sometimes months, for the market to confirm the exact moment I should enter. I would watch the price action, observing the great stream of quotations, waiting for that absolute clarity when the line of least resistance was undeniable. If the setup is not perfect, if the risk is not precisely measurable, if the timing is ambiguous, if the volume doesn't confirm the initial move, then the only rational trade, the only trade that demonstrates true discipline, is to remain 100% in cash. Inactivity is not passive. It is an intensely active form of observation and preservation. You are preserving your primary weapon, your buying power, for the moment when the opportunity is statistically overwhelming. The emotional man fears inactivity because he fears missing out on a move. The disciplined man cherishes inactivity because he knows every day he spends waiting for the perfect moment is a day he did not inject random noise into his carefully structured enterprise. When you enter a trade, you are metaphorically climbing into the cockpit of an expensive and delicate aircraft. Do you simply pull back the stick and hope for the best? A professional pilot does not take off without filing a flight plan that includes exhaustive emergency procedures. They know exactly the altitude and bearing required, and they know the exact point of no return if mechanical failure occurs. The emotional speculator enters a trade focusing only on the profit potential. He stares at the ceiling of the flight and ignores the ground. The disciplined speculator, before placing the order, focuses first and exclusively on the stop loss. This I call the pilot rule. Before you buy a single share, you must define the price point that proves your initial thesis definitively wrong. This is critical. The stop loss is not a sentimental level, it is an intellectual level. It is the point where the facts of the market action definitively override your judgment. If I buy a stock because it is trading above the support established at 55, then the moment it trades decisively below 55, my thesis is invalidated. My reasoning was flawed. The stop must be set precisely at the point of logical invalidation. This pre-commitment removes the emotional debate entirely when the inevitable loss occurs. When the price drops and the pilot rule level is hit, there is no argument. There is no second guessing. The market has delivered the verdict. The pre-commitment requires immediate mechanical execution. The emotional man sets a stop loss and then, when the price approaches it, he moves it down, just for a little while, hoping for a rebound. He argues with his own flight plan. He invites fear and hope back into the cockpit. He is doomed. The disciplined speculator views the stop-loss as the boundary of reality. Once crossed, his original premise is history, and the only logical action is to save the remaining capital. Preservation of capital is the paramount duty. Never, under any circumstances, allow the market to determine how much you lose. You must always predetermine that figure. That is the essence of cold, emotionless management. One of the most dangerous, most common errors committed by the emotional trader is the disastrous habit of averaging a loss. Averaging down is when the price goes against you, and instead of cutting the position as discipline demands, you decide to buy more shares, believing that if you lower your average cost, the small rebound that hope promises will allow you to get out even. Averaging a loss is not strategic. It is the emotional need to be proven right. It is doubling down on a mistake, driven by ego and false hope. When you average down, you are taking a position that is currently losing money and increasing your exposure to that loss. You are taking a single manageable error and compounding it into a potentially catastrophic failure. I learned early. When you are wrong, you are wrong. Cut the loss. Reset your mental state. Preserve your buying power. Your buying power, your available capital, is your weapon. You do not exhaust your weapon trying to save a battle that is clearly lost. You retreat, resupply, and wait for the next confirmed opportunity, where the odds are demonstrably in your favor. The emotional man cannot stand the idea of taking a loss and admitting his error. The disciplined man welcomes the quick, clean loss because it validates his system of risk control and clears the deck for the next high-probability trade. The speculator who averages down is demonstrating a profound lack of respect for the market. He believes he can outsmart the market's trend simply by committing more capital. The market has no memory of your cost basis and no compassion for your ego. It will crush the speculator who attempts to fight the tide with sheer stubbornness. My rule was absolute. Never average a loss. Never. If the position is against you, you have violated a fundamental principle, and the penalty is immediate liquidation. Use the preserved capital to initiate a new, better researched position in a security that is actually moving in the intended direction. The emotional trader is often driven by internal conviction, a hunch, a feeling, or a deeply held belief that a stock must move a certain way based on his own analysis of industry fundamentals. This conviction is deadly. The market does not care about your fundamental analysis, not in the short term. The market cares only about the price and volume action on the tape. Emotional trading is based on anticipation. Disciplined trading is based on observation. My system was built entirely on observing market action and waiting for the line of least resistance to be definitively established. I did not lead the market. I followed it. Conviction says, this stock is cheap, it must rally. Confirmation says this stock is cheap and now heavy buying volume is pushing it through key resistance at 50. The market is confirming the direction. The disciplined speculator waits for the evidence to precede the trade, not the other way around. If I bought a security, it was not because I personally felt it was a worthy company. It was because the price action and volume demonstrated clear institutional accumulation, proving that the money was flowing in that direction. Conviction is subjective and changes daily with your mood. Confirmation is objective and registered on the tape for all to see. Consistency demands that you remove your personal opinion from the process. Your opinion is worthless. Only the market's behavior has value. Wait for the market to prove your idea correct before you commit capital. If you find yourself in a trade because of pure conviction, you are trading emotionally, and you are already in danger. The need to constantly be involved in the market is a psychological affliction driven by excitement and primarily the fear of missing out, or FOMO. The tape is a tempting mistress. It offers action 24 hours a day if you look hard enough. Every hour there is a stock spiking or a commodity collapsing, and the emotional man feels compelled to be part of that movement. Overtrading is entering poor setups just to satisfy the impulse for action. This is the fastest route to guaranteed inconsistent returns. You introduce random noise and low probability trades into a structured high probability system. You dilute your focus and exhaust your mental capital. If you have a system that promises a success rate of 60% on setups that meet 10 precise criteria, and you suddenly enter trades that only meet 5 criteria just because you are bored, you have compromised your entire structure. You are gambling with the house money. Emotionless trading means accepting the periods of quiet inaction. It means accepting that sometimes the greatest profitability lies in the quiet, reasoned rejection of mediocre opportunities. My best trades were always those where I waited patiently, initiated the position with maximum confidence at the exact right moment, and then stood back and let the market do the work. My worst trades were always those initiated out of impatience, curiosity, or the impulse to simply be involved. A professional baseball player does not swing at every pitch. He waits for the pitch that is perfectly in the zone, where he has the highest statistical probability of a solid hit. When the market is delivering mediocre pitches, the disciplined trader simply watches the ball go by. You must overcome the psychological need for excitement. If you need excitement, go to the racetrack. If you need consistency, sit on your hands until the perfect setup materializes. Consistency requires a clear, objective mind. High emotion, whether euphoria or despair, fundamentally compromises judgment. After a major emotional event, be it a massive, unexpected loss or more subtly a spectacular, large win, the trader's ability to analyze data and execute mechanically is severely impaired. The man who just made $1 million in a swift move is high on adrenaline. He feels invincible. His ego is inflated. This is the moment he is most likely to over-leverage or violate his risk rules, believing he has solved the market forever. The man who just suffered a devastating, gut-wrenching loss is paralyzed by fear and guilt. He is likely to take a marginal setup just to get the money back, or he will fail to pull the trigger on a genuinely good setup because the pain of the previous failure is too fresh. I quickly recognized this fragility in my own temper and enforced mandatory breaks. The disciplined speculator recognizes their psychological limitations and enforces a cooling-off period. You must detach from the P and L swing and return to baseline objectivity before committing new capital. If I took a large loss, I would close the office for the afternoon. I would go for a long walk. I would force a change of scenery to break the psychological loop of panic or revenge. You cannot analyze data effectively while your adrenaline is high or while the ghost of the last trade is sitting on your shoulder. You must cool down until the numbers on the screen are just numbers again, not reflections of your genius or your failure. This mandatory break is a powerful act of discipline. It is prioritizing psychological recovery over immediate opportunity. The opportunities will always be there tomorrow. Your mental acuity may not be. Most speculators track their progress by tracking only one number, the profit and loss line. How much money did I make today? This is a profound mistake. Profit is merely the result of discipline, not the definition of it. You can be profitable today through pure luck while violating every single rule in your book. This is, paradoxically, the most dangerous kind of day. The truly consistent trader uses a secondary ledger. This ledger tracks the consistency of his execution. You must track every trade where you violated your own rules, even if the trade was profitable. If your system demanded a stop at 50 and you moved it to 49, but the stock subsequently rallied, you made money, but you failed the test of discipline. You must mark that trade as a failure in the ledger of execution. A successful outcome based on a failed process is poison. It reinforces the terrible habit that rules are optional. It teaches you that gambling sometimes pays. If you violate the rule and lose money, the market corrects you instantly. If you violate the rule and make money, the market grants you a false sense of security that will cost you 10 times that profit on the next violation. I was more concerned with adherence to the system than I was with the daily tally. If I executed my system flawlessly, I knew the profits would materialize over time. If I executed my system poorly, even if I was up on the week, I knew a disaster was pending. Measure only adherence to the system. Hold yourself accountable to the process, not the outcome. This is how you build true unemotional consistency. When you enter this game, stop trying to become a machine. That is impossible. You will never eradicate your feelings entirely. You will always feel the pull of greed and the cold hand of fear. Instead, learn to structure your trading world, your systems, your rules, your execution mechanics, so that those feelings cannot interfere with the operation. Build the steel cage. The rules must be defined in moments of cold, detached logic, when the market is closed and the pressure is low. They must be executed flawlessly in moments of high pressure, when the ticker tape is screaming and your account equity is swinging wildly. Consistency is not about high intellect or perfect predictive ability. It is not about discovering some hidden secret of the economy. It is the tedious, methodical, almost painfully boring adherence to a plan. The market does not pay the emotional man who chases every fluctuation. It pays the methodical man who sits still, waits for his exact moment, executes his pre-planned orders without hesitation, and accepts the loss without complaint. Master your discipline, master the mechanics, and the profits will follow. That is the only secret. It is the hardest work you will ever do. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich. Because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I've created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So, if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.